I want to bring in David Lafferty. He's the Chief Market Strategist at Natixis Investment Managers. Great macro analyst here to help us try and make sense of this. David, thanks for joining Market on Close. So now that we've got a couple days of gains under our belt, what does it mean for how the market responds to trade progress? If there's a truce, I mean, do we know if it's baked into markets? Do we know if it's a big rally if we get it? How do we figure this out?
Yeah, it's a great question. I don't think it's a huge rally. I think people will always be skeptical of it, Oliver. The reality is that we'll take any good news we can get, but I fundamentally don't see the big issues being addressed. This reminds me a little bit of like when your parents are getting divorced. They don't like to talk about it in front of the children. This is basically turning down the rhetoric, right?
Yeah, I like it though, David.
We want to keep the economy on a reasonable path. We want to keep markets reasonably happy. We just don't want to kind of talk about the real issues in front of the kids. And so we'll take whatever gains we get. But I think my view for a long time has been they're largely temporary. I don't think that we're going to really, truly address any of the issues. The idea of a currency pact was already on the table back in February or March. And the minute the president threatened tariffs that first week in August, the Chinese basically allowed the RMB to fall 3.5–4%. So I'll take these gains, but they feel kind of temporary, at least on the trade news alone.
David, I'll even take it a step further to maybe play a little devil's advocate here on the bearish side, which is if there is a spike in stocks after some deal, to me that's basically sentiment relief, which could go a ways down the road if it means sentiment relief for business owners and undoing some of the CapEx stalling that we've had. But in the short term, if we look at earnings expectations, right, tech's looking at a 10% earnings drop. The S&P 500 has continued to be revised lower by analysts. Is that kind of the real issue that you're discussing?
I do. I mean, I think that's the issue that underlies all of it. I mean, the markets have really been buffeted in the last 6 to 12 months by all the geopolitics, the trade talk, the Middle East, everything. But people have to remember the earnings trend underneath it has been very soft. And I've been on the program before. I've said it a number of times. We're looking flattish this year. The bottom-up consensus for near 10% in calendar year 2020, calendar year 2021, another 10%. In a global economy that's growing at 5% nominally, that's about 3% real and call it 2% inflation. Really hard for companies that already have fairly high profit margins to grow earnings at 10%. When their top line is probably going to grow at only 5%. So we think the number's positive. I think earnings will be up in the next couple of years. I just don't think they'll be up anywhere near 10% unless we get something big on the trade front. And even that, those effects will come through with a fairly large lag, I think, again, resupplying those supply chains. I think it's not something that happens overnight. And CapEx will begin to pick up, but again, not something that happens immediately overnight.
David, if we talk about the real economic impact of trade relief coming with some kind of delay, obviously, right? Is there still a possibility that it has a trade deal or truce an effect on what the Fed does or the market's perception of what the Fed does? Or are we clear for that October cut no matter what happens tomorrow?
I still think we'll get the October cut. We've sort of changed our mind. We after the September meeting, we thought there'd be one more cut this year, either in October or December. And I was sort of leaning towards December. Given the weak ISM and the PMI data, it looks like October is much more likely at this point. It's pricing in at about 85%. I think it's high enough where Powell isn't going to want to, disappoint the market. So I think October is more in line, and we'll hear a little bit more about the plan to add some reserves. Again, Powell's been clear it's not QE, but adding some reserves to the balance sheet, freeing up that repo market. So we'll get more details on that. I think we will get a cut. To your earlier point, a deal is really sentiment driven, but even some optimism that comes with that may be offset if it does give sort of Powell the all clear to hold the line a little bit more, not reduce rates. I don't think interest rate hikes are back on the table anytime soon. And we might even give back some of these sentiment driven gains. Again, I don't think that's going to happen in October. I think October is baked into the cake. But yeah, your question further out, maybe it does take a little bit of the burden off of Powell.
Yeah. David, along those lines, to me, the most important chart here remains the 10-year yield and whether or not it bottomed, because it's almost looking like we got back to, we know gold has made a series of lower highs now. It's the chart I keep coming to. Bonds today selling off pretty sharply, not just around the trade stuff, but really the jobless claims that were pretty solid seemed to cue the downside this morning in bonds as they surprised with fewer, jobless claims. But the sensitivity for this market now becomes really interesting, David, because today you've also got value factor actually outperforming growth. Even with the positive trade news, you've got value doing a little bit better, which it's starting to look like moves very closely with yields. So what are the implications for stocks if we saw the bottom in the 10-year yield?
Well, I think it would be good for stocks. I mean, again, this all comes back to trade and whether we're going into recession or not. And I always give the same answer when we're asked, do you think the 10 years bottomed? My answer is always, well, are we going to have a recession or not? The answer is if growth slows, I don't think the 10 years bottomed. Our base case is that we kind of struggle through. The 10 years probably range bound. My best guess, and I emphasize that it's a guess because, again, our base case is we don't go into recession, but I'm not 100% sure of that, is, yeah, I think the bottom's in, but I could change my mind pretty quickly. Particularly, as you mentioned, the key number to look at is those weekly jobless claims. We've seen weakness in some of the other areas of the employment market. We've seen non-farm payrolls, not bad, but softer. Some of the employment data within the surveys has been softer, but that Thursday morning unemployment claims number has been rock solid, and that's the one I think people should be looking at. If that stays solid, yeah, we're probably range bound on rates, but I do think the bottom's in. But that's contingent on us being right that we're slowing but not headed into a recession.
David, one of the other things here is about which parts of the market work. We know that when there's cuts on the horizon from the Fed, it's been a very good environment for spending on stocks, basically. No matter the valuation, that's okay. But what we've seen lately is horizontal movements in the price for software stocks. Some still getting hit, like CRM, Autodesk. Some of these hallmarks of high valuation tech look like they're buckling a little bit. Even if we do get a cut, if there is a bottom in the 10-year yield, is that going to start to weigh on some of the expensive stuff?
It's hard to say. I mean, I think what we've seen is this huge rotation into anything that kind of looks like it has yield. And I worry that people are trying to play defense with the most expensive stuff. I think the best way to play defense is with the cheapest stuff. And again, there's a lot of hair on that. I mean, we've liked banks and financials for a while. They're having a nice little run today for two reasons, as you mentioned. Yields are up and the curve is steepening. But I would rather be in the cheap stuff, given kind of our view of the risk-adjusted nature. Again, our view is that the market probably grinds higher. But if we're wrong, there is much more downside to risk assets, particularly the equity market, but also things like high yield and commodities. There's much more downside to this market if we're wrong than there is upside if we're right. So I think people should stay in stocks, but you got to be a little bit more cautious. And cautious to me doesn't mean defensive. It doesn't mean utilities and staples. That stuff is pretty expensive. It maybe means healthcare, banks, energy, something like that.
Yeah, all right. David, really good stuff. Always a pleasure. We got to run. Nice work. David Lafferty joining us from Texas. As always, really interesting take here on the market.